Welcome to The Interest. I'm Katie Jensen. Today, we'll kick off the week with our Master the Markets segment before tuning in to another Cage Match episode with our own Vincent Valvo and Andrew Berman. But first, let's address everyone's favorite topic, trigger leads. For anyone that's new here, trigger leads are leads that are sold and distributed to various companies like mortgage lenders by the credit bureaus once a consumer has their credit pulled. Those lead buyers then call the consumers to compete for their business. Everyone in the industry seems to have an opinion on them. Advocates say that they drive market competition and prevent consumers from getting price gouged. But opponents argue that consumers feel harassed by those calls and could be in danger of getting scammed. The major trade associations representing originators have sided with the opponents, saying they're deceptive, dangerous, and hated by most consumers, while trying to push forward legislation that largely bans the practice. Over at NMP, we don't care so much for opinions as we do for facts. So we asked who could prove their argument with empirical evidence. Stay tuned to find out. There are many anecdotes about borrowers getting besieged with phone calls, texts, and emails containing misleading offers due to trigger leads. But if anecdotes are given weight, what about the ones from loan originators who say trigger leads have helped them find borrowers better deals? I called trigger leads for a long time and honestly saved customers a lot of money by getting hold of them and being able to do better than what they had already been offered and agreed to. That was Allie Malcolm, sales coach for Man Mortgage, in response to a LinkedIn post. If both experiences can be true, then which one is the most common experience for consumers? That is where the trouble lies. There is no supporting data that shows more consumers believe trigger leads do more harm than good, or vice versa. There's no publicly available survey on consumers' opinions or even originators' opinions on trigger leads. Asked for information about consumer complaints about trigger leads, the Federal Trade Commission, FTC, the Consumer Data Industry Association, CDIA, and the three credit reporting agencies had nothing to show. Quote, "We don't have data specifically on this topic," a spokesperson for the FTC said. The FCC and national credit reporting agencies all declined to provide any information regarding consumer complaints over trigger leads. Even the legislators who introduced the trigger lead reform bills to Congress, U.S. Representative Richard Torres, U.S. Representative John Rose, and U.S. Senator Jack Reed, have yet to show empirical evidence to justify legislating away trigger leads. Meanwhile, the CFPB didn't even know how to search its own database for trigger lead complaints. After following the search procedure the CFPB spokesperson recommended, most of the complaints it brought up were not related to trigger leads. So why are the major trade associations advocating legislation that largely bans the use of trigger leads when there is no evidence showing they're mostly harmful? The National Association of Mortgage Brokers, the Mortgage Bankers Association, and the Association of Independent Mortgage Experts has made no attempt to gather evidence about consumer opinions nor the originators' opinions, the voices they are meant to represent. Yet all three trade associations advocate legislating away trigger leads.
But when you have an overwhelming number of consumers complaining, it is pretty easy to presume that it is an unwanted circumstance of the environment that we have right now.
NAM's president Valerie Saunders claimed an overwhelming number of consumers complain about trigger leads, but could not provide evidence to support that claim.
So I do not have an empirical number, nor do I believe that any other trade association or government agency has an empirical number.
When asked how she came to assume an overwhelming number of consumers dislike trigger leads, Saunders said it's a common dialogue in her circle of peers.
The reason I say most is because it is a common dialogue among loan originators that we communicate with and other trade associations that we communicate with.
However, Saunders admitted NAM did not survey or ask its members about trigger leads before announcing its support for legislation. The board is also unaware of how many members potentially rely on trigger leads to stay in business.
NAM has not polled their members to see who is or who is not using trigger leads.
To read more, check out the full story, Are Trigger Leads Harmful? Prove It, on nationalmortgageprofessional.com. For The Interest, I'm Katie Jensen.
We all dream of owning a home, but for too long, if you didn't fit the mold, you were stuck. Stuck because the system worked for everyone except you. We've changed that. Angel AI uses advanced AI technology to give a 100% trusted solution and fast answers for worry-free financing, allowing you to achieve fair and equal access to lending. Angel AI. AI you can bank on.
Hey friends, thanks for tuning in to our Master the Market segment. So last week it was all about inflation. Fed's favorite gauge came out. Core PCE came in meeting expectations, 2.6%, the lowest in quite some time. But the bad news, Fed thinks that's the bottom for the year. They're forecasting inflation goes up from here. And it's a reason why they're forecasting only one rate cut. Well, we're going to find out some more this week because the Fed minutes come in what's going to be a holiday shortened week. And those minutes are going to verify maybe what other Fed members were saying. So that could be a market mover. And then it's all about the other side of the Fed's mandate. That's the labor market. We have the jobs report next Friday. That's a big one. Obviously, if the labor market print comes in low, that's going to help bonds because bad news is bad news. And the opposite is true. Listen, at Mortgage Market Guide here, we're watching 435 on a 10-year note, key level. We want to make sure that yields stay below that as they have over the last couple of weeks. Have a great week, and we'll be talking to you soon. Bye for now.
Okay, Vince, we're going to start this cage match with a little look back. Remember, it's October 2022. I sound the alarms about rising insurance down in Florida. Mm-hmm. I didn't know actually how bad it was going to get, but it is it's resulting from a lot of things that we're seeing with climate change. We're obviously seeing premiums just through the roof, just companies just shutting down their operations in some cases. But climate change is a major contributor to this. What are your feelings about how climate change has impacted? And once again, I'm right. I don't always like Michael Burry. I'm not always timed right, but I am always right in the end. So, what are your feelings about climate change impact on housing?
Wow, that's kind of open-ended. It's not just what's happening with insurance rates in various states
100%.
And whether or not those insurance rates ought to be taken by the state insurance regulators and crammed back down so that they're a more reasonable rate. That's a whole different conversation that we should have here.
Like nationalizing insurance companies?
No, I said by the states. Let the states go ahead and cram it back down instead of being in the pocket of the insurance companies. That's what I think ought to happen because they're going to have to do it at one way or another if they want to actually have a housing markets in Florida and California. That's going to have to happen. In any event, I do think that there are issues with what's happening with climate and with housing. I do also think that there's a real problem that's out there right now in that I say a real problem that I have a question about, okay? So just recently there was this gathering, AmeriCatalyst, bringing in government folks, agency folks, insurers, and people from the mortgage industry to talk about the effect of climate change on housing and what needs to happen, particularly in the lending environment. It was a fascinating conversation. It was invitation only. We had our reporters there. But here was who wasn't there. The lenders. The lenders weren't there. One or two risk managers for some of the big lenders had shown up, one or two. But for the most part, the lenders didn't pay any attention to it.
There were some lenders there. You can't say none.
Yeah, well, given the whole scope of lenders that are in the nation, having two or three doesn't really count as having a strong industry presence if we're thinking that this is a big to-do.
Yeah.
I think that maybe the issue here is there is climate change. There are issues that are affecting us. There's still some question as to whether these are transitory issues or whether they are permanent issues, and which is why some of the lenders probably aren't necessarily paying attention right now because they may be thinking some of this is more transitory.
Yeah. And I think, listen, lenders are also, by default, we're a reactive bunch. Like we will change, we'll adopt and do whatever we need to do, but sometimes we need a little bit of, oh my goodness, I'm going to say the R word, regulation to have us do this.
We need a kick in the pants, or we need a real catastrophe. But part of that is also because there's so much, doom and gloom out there. Listen, this is a very quick anecdote. 20 years ago, we're here. We are recording this in Connecticut, and there was a group, the Connecticut Community Bankers Association, the folks who were lending in all the towns and stuff, and they had a monthly meeting, and they had a speaker there, a guest speaker, lots of charts, lots of graphs, very good. This guy knew his stuff. And it was all about how climate change was affecting the Connecticut shoreline. And Connecticut has a lot of shoreline along Long Island Sound. And the climate change activist was like, holy smokes, look what's happening. You're going to see rising sea levels. You're going to see erosion. If you have loans for all these properties along the Connecticut shoreline, you can kiss those loans goodbye. Now, it was a very dark and dire warning, and it was 20 years ago, and none of those loans have gone bad since then. You begin to tune this stuff out. If it becomes too catastrophic, too cataclysmic, you must do this stuff, or the world is going to fall in. And I think that's one issue that some of our lenders are facing now. They need to see this in a more not progressive in the sort of future, but in terms of a little bit of progress here, a little bit of progress there, steps at a time to move forward. And they don't really have any incentive to do much of anything at this point either.
Well, the insurance companies are maybe forcing that scenario down then because in the cost of insurance is impacting affordability. You have in some cases where you have the principal and interest is almost parity with the taxes and insurance.
Right, and I get that, and that's why I'm saying what's going to happen in those states. We know it's going to happen. Because you know why? This isn't affecting the lenders. This really isn't even affecting the real estate agents. It's not even affecting the insurers. It's affecting the buyers and sellers.
No.
The buyers and sellers are voters, and they will turn to their government and they will say, you, government in Florida, you, government in California, need to do something about this. And there will be programs that either create state-funded programs, or there will be where the commissions turn to the private insurers and they will say, we are going to mandate these kinds of price changes for you. It's going to happen.
I agree, but there's nothing to even fight with this one. I agree with this one. Yeah, we're in lockstep, unfortunately, which is not a great thing. Well, and I think one of the things. So Ryan went and he said that
Ryan Kingsley, one of our staff writers, who's big on this.
Yeah, and he basically said that there's no solutions. There's no one's talking about solutions.
That is a problem, right? That is the problem.
Yeah,
because I'm not sure that they're recognizing that there is necessarily a problem. They know that there's a problem right now.
Yeah.
But those of us who are old lived through gas lines in the 1970s. There wasn't going to be any more oil.
Yeah.
Oil was going to be gone. And yet here we are. We still have oil. We still have cars. We still have gasoline. A lot of folks go, let's wait to see if all the the henny penny, the sky is falling stuff disappears, and we're patient about this a year or two. I'm not saying that you ought to be patient. I'm saying that that's what their approach is, because otherwise it's very expensive. The answers that you start to come up with have big price tags on them.
Well, no one wins in this one. It's not the insurance company. It's not the mortgage company. It's certainly not the borrors.
Right. And it's not
us.
you, but it is me. So,
wait, no, you can't go game.
No, victory.
No, wait, no, you can't. That's not how this works. No, it's not.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.